Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are happy to have you with us today. Once again, I have my great friend and my great pal. It's a sunny day. You can't go anything wrong with this. Al, how the heck are you doing today?
No complaints. I must be doing really well, I guess.
Hey, you're not 10 toes up, and you're standing up, and you're looking good today.
I can stand up and I can walk in a straight line. Those are two good things.
How many drinks is that after, though?
Well, this is without any drinks.
Okay.
I'm just concerned about being able to get up and walk in a straight line when I want to.
All right, that's good you have coffee in there. It's always great to be back helping our Retire Young family make better investing decisions. Al, once again, we have a big show today. We're going to talk about, the financial market conditions, what's happening in these markets. But I really want to get into these other asset classes because there's some great opportunities within these other asset classes. We have the futures market. There's a lot of opportunity there with some of the different commodities, the Forex market, the currency market, but also the options market. Before we do that, Al, talk about current market conditions. What is happening in these financial markets? We're seeing a lot of movement again, up and down. And how are you helping people participate in these markets?
Yeah, you're exactly right. We see these big moves. You know, it's interesting. 6 months ago, a year ago, if we had the Dow move 100 points or more, you know, people freaked out or got
they were
really
falling
excited.
off their chair.
Yeah, and just the other day, I was talking to someone. They asked what the market did. I think it was down 150 points. They said, "Oh, hardly anything.
Yeah,
there's no big deal." So you know, we're kind of getting used to these huge moves, and these huge moves present some great opportunities. You know, we kind of over the last few weeks have talked about the market being desensitized to things that are going on, and now it seems like that more sensitivity is kind of coming in, especially as it relates to the coronavirus. But I think the bottom line is that you're going to find opinions that vary, you know, and you could analyze or listen to 100 different people and find, you know, 50 people that might lean one way, 50 people lean the other way. It's really important now not to fall into that trap of listening to other people's opinions and instead do what the market is showing you it's doing. It tells us what it's doing, and basically what it's doing is what the institutions are doing. That's what we want to do. We want to follow what the people that have the big money are doing.
So how does that really happen then? You said the big institutions, I mean, they're moving the market, right?
Correct.
So it's the big money, big volume that's coming into the market. Explain how supply and demand works in the financial markets. Most people probably know how that works in their everyday life, and the financial markets is no different.
Right. There's really very few things that are guaranteed, but really what is guaranteed is that relationship between supply and demand. When there's more demand for anything, the price will go up, regardless of what the market is, what the asset is, and the opposite is true also. When there's more supply, price will go down. And that is true in the financial markets. And it's driven by institutional or big money activity. You know, you and I can't move the market enough when we enter a position or exit a position. But when you're talking about several 100,000 shares of something, or maybe 1 million shares coming in at a certain price or exiting at a certain price, that's what has impact on price. That's the engine that drives the movement of price.
It's very similar to like an auctioneer then. If an auctioneer is trying to sell an item, let's just say this cell phone I have in my hand, and this cell phone is worth, we know it's worth, you know, we'll say $1,000,
Mm-hmm.
and they're going to say, okay, we're going to sell this cell phone for $500. You're going to have a lot of people bidding for that, so many buyers. So what is price going to do? Price is going to go up, and it's going to go until that equilibrium, right?
Right.
And then when there's more supply, which would be this one cell phone, price will go down if there's no buyers for that.
Correct. It's all that relationship. It's the balance or imbalance between supply and demand. And the education that we provide our students really is geared towards identifying not only that imbalance, but what it's going to do as far as impacting price down the road. So if the institutions are going to be taking a position, they can't do it in most cases, they can't do it at one time, because a large order the size that they probably want to be participating in would be too big, the demand would be too great, and they would have a hard time getting filled at the price they want to get filled at. So they'll do it in increments, maybe have a limit order. And when we know with a high degree of accuracy and that's repeated, so the key is to be able to identify when that's going to happen. That should be the goal of a good educational program.
Now, you mentioned a term called a limit order. A lot of our listeners are brand new to the markets, which is actually a great thing. Now, what do you mean by limit order?
Right. Well, let's just say that you want to have a position in a particular stock and you think it's worth a certain amount, let's say $100 a share. And you don't want to do a market order is just telling your broker to buy you shares of something at whatever the market is at that particular time.
And when you mean a broker, that's like a brokerage on account on a platform,
Correct.
on a computer.
Yeah, well, all orders have to be placed through a licensed broker. It could be one of the discount brokers. It could be one of the major firms. But all orders have to go through a licensed broker. And a market order is just saying, okay, Mr. Broker, I want to buy, say, 100 shares of stock X. And they will go out and buy it at whatever the price is at that time. But if you think stock X is only worth $100, you can say, I would like to buy 100 shares of stock X, but I only want to pay $100. That's the limit I will pay. That's a limit order. And that's what institutions do because they know what the value of something is. They've done a lot of research. They have data that we probably never get or get too late to do anything with, so they understand what the value is, and they have the patience to wait until the price gets to that value. And that's a great thing for us and this is a good part, another part of an education program is teaching patience. Wait for the market to come to a level where you can get a good quality entry or exit position.
And that's the nice thing about trading and investing is as an investor in Wall Street and the big institutions, they're setting their prices so they don't have to chase price. I mean, you can place market orders as an investor, but if you can place it and dictate your price, you might get better we'll say lower prices if you're trying to buy. So that's why it's so important to understand that terminology and how the institutions are trading and investing. And Al, thanks for listening. Don't forget to check out the website at retireyoungaudio.com and leave us a comment.